Hello and good morning. This is Mike Williams from Genesis, and we hope you're having a great day. Once again, we've got a video here. We're going to do a lot more of this year. We kind of backed off a little last year because, well, there wasn't much news to talk about other than the market going up. As we suspected, somewhere in here there'd be a rest. This one has been steep only from the perspective of it took so long to arrive. The picture you're looking at right here is the spiders, which are up 3/4 of a point after the announcement of GDP this morning, at least the first run of GDP at 3.2%. I have to remind you that, a few years ago, if you said GDP grew at 3.2%, the world would be cheering. But today we're still afraid that it's just one more print away from 2008 and 2009 events again. So the fear is still quite deep, and the doubt and the, gee, I don't know if that's really something we can believe in kind of theory is well bred into everyone's mind. Now, the other side of the screen where my cursor is spinning around is the TLT. That's the ETF for the 20-year Treasury. I can use either that or the futures contract for the March 30-year bond. They all look alike, and I'll refer to it a couple of times. What I want to note for you before I go back to the TLT is look at this. We hit a new high in this contract. And remember, these contracts only go 3 to 6 months. They renew every 90 days, so you only get a batch of activity. This is a futures contract. So note that while the market has been selling off, bonds have, of course, been rallying as fear is stoked and safety is searched for. And I use the word safety in quotes. Excuse me, I got to get some water here. It's compelling to note the inversion of these two charts. Here we have lots of volume piling in on up days. We're heading back to resistance, and we have overbought indications on our little chart indicators we've been using on all of these update videos. And back on the S&P, of course, the spiders, we are rapidly approaching those areas where really key important levels take place on volume. And of course, look where we are. We're down in oversold territory. I wish I had the latest data on the AAII. I don't, but sentiment numbers will be out shortly, and I fully suspect that we will find that this last week or two has shellacked the confidence level of many. We already know advisors are shoveling over to the correction fear side of the scale rapidly, so you can expect their clients will go to as well. Look, that's it's becoming clear that this is the first crisis to worry about in 2014. God knows the media was searching hard for it. But as the Fed told us all yesterday, and as our friend Dr. Ed wrote in his notes this morning, look, emerging market issues are arising because of two primary things. One, the United States is doing better. When the United States does better, their currency rallies against the emerging market, smaller economies, and that doesn't help them compete. The other item that is hurting their economies and hence their currencies that you're now suddenly being made an expert over, the the Peruvian and Indian currency are now vitally important apparently. I say not, but those are the headlines. So, but the reason is China. The other reason is China is coming well off its quote-unquote scorching pace of growth, still growing nonetheless, but not approaching those levels where they're going to take over the world, as was thought, I don't know, 12 to 18 months ago. So when you combine those things, obviously our strong GDP print is certainly not going to help the dollar get weaker. What's also interesting in the Fed notes yesterday, before we get to these screen details, is that they continue to be concerned about something we wrote about a few weeks ago, and of course that was a theme in many of our notes over the past year, and that is this rampant fear of inflation. We have to understand that money has been flooded into the system in hopes of it actually being lent by banks instead of kept by banks, uh, for one reason: to fight off deflation. You actually want some inflation. We want inflation to be in the system. Rest assured, you do not want deflation. And we are, continuing to note for everyone that if we want to worry about something, we shouldn't worry about inflation. We should worry about deflation. And we should want policies that drive growth and risk-taking and investing. And I don't use that term risk-taking as a, gee, throw all concerns to the wind and put it all on black. That's not what I mean by risk-taking. What I mean is, no matter what you do, you're taking risk. But taking risk and the art of taking risk and the process of starting small businesses and the process of hiring people and the process of solving problems. I was once told the successful small business is just a series of solving problems and fixing errors. And anyone who's ever built a business will probably agree with me there. But I don't want to get off course here. I guess the point is that taking risk is what built our economy. Taking risk is what built every single thing you use in your life. Taking risk is what built any wealth you have. If you have wealth, you took risk. Bottom line, that you can't get around it. If you have wealth from the stock market, you took risk that you might lose money. And oftentimes you did, by the way. If you have wealth from real estate, you took risk in buying something others hopefully buy from you later at a higher price. You're risking interest rates, you're risking leases, you're risking tenants, you're risking problem tenants, you're risking bad development ideas, you're risking collapses in real estate value like we saw that drove the 8 and 9 financial crisis, or certainly lit the fuse to it. So everything is a risk. We have to get that that thing that automatically triggers in our brain when we hear the word risk, that special shot of endorphins that makes our heart beat faster and our blood pressure rise and our pulse quicken, as though there's something horribly wrong with risk. Unmitigated, unmanaged, unthought of risk, throw risk to the wind, throw all concerns to the wind, that's something to worry about. But risk is part of every single investment you will ever make. It is part of every plan you will ever derive. It is part of every plan you will ever implement. That's just the name of the game. And we can try to get around the elephant in the room, but you have to know the elephant in the room exists. So that all said, let's go back to some of the same stuff we've talked about before. But I want to give you some pictures to just logically register in your mind and let it kind of sink in, and you have to ask yourself, does it sound correct? Now, let's talk about these last few days. Obviously, this has been a quick jaunt down for a 4 or 5% setback since we ended the year, and of course, follow my cursor, that is the end of last year. That's where we closed, and of course, we're now down a tad bit over 4%. And all of that happened in a matter of 1, 2, 3, 4, 5 trading sessions. So it's been effectively a week. The excuse has been the emerging market crisis. And then, of course, yesterday we were welcoming to crisis the further lessening of QE funding by the Fed, which they announced at 2 o'clock. And of course, the markets immediately got a little bit more volatile. They were already shellacked and already down, but the excuse was, oh gosh, stocks are pummeled because Fed withdraws more QE benefit. Well, that sounds great, but look, let's just, why don't we stop lying to ourselves and just say QE leaving is good news. It means things are getting better. It means, yes, rates will rise because the economy is gaining strength. Things will normalize eventually, which is why I ask you, does it seem logical that people would be selling equities in a future growing economy, which oddly enough, if it's growing and if it's future oriented, a long-term investor would expect things to become more valuable, not less valuable. In addition, that very same investor would have to say to themselves, okay, if things are going to normalize, and if data is getting better, and if GDP is picking up, and investment is picking up, and if in fact things are going to become more valuable, then the other part of that normalization is rates will rise. They won't stay rock bottom forever. So doesn't it sound illogical in that set of circumstances to sell equities and buy bonds? Now, just think about that for a second and recognize we're getting all of the footprints. Now, look, do not take this little video coaching session as a statement of, oh, we've seen the lows and no more selling will occur. No one can ever make that statement, and I don't want this to be confused as such. We have to go on footprints in the sand, and we have to surmise and make an educated guess that like-looking footprints probably mean the same thing or close to the same thing or like the same thing that they've meant in the past when they all kind of corralled together. And we're getting all the same things. We're getting sell-off back to support. Remember this little support channel. And by the way, we just touched it. We just dipped into it. I find it fascinating. Watch this. It's the same video support levels we noted yesterday. Notice what's happened in 2 of the last 3 days. We ducked right in and they bought it right back up. We ducked in and they bought it right back to the literal penny of the note here, 177.35. Now, there's no magic to this support level. You can move it $1 either way, but what it is the last breakout. Last breakouts are often tested, and you want them to stop before they get to the previous breakout. Well, the previous breakout is the high before that breakout. So that's why this little channel was sort of pointed out as a target for a setback. The things you want it to test. Now, traders will tell you that yesterday's activity took the stops out from here and here. And then, look what's happened this morning. We're rallied back. Now, the market hasn't opened yet. It's going to open in 12 minutes, but it's up over 3/4 of a point, and it's going to open somewhere. I'll move this little cursor up. It's going to open somewhere around right about here. That's where it's going to open. So that's a pretty nice little bounce on the open. But what I'm trying to point out to you is get the feeling of what's going on. You can sort of get a sensation of getting in the minds of the crowd. Okay, what's the crowd doing? They're selling equities and they're buying bonds. They're doing it in fairly high volume. Let's just so we know, let's go back to the ETF so that you can see that volume is picked up as well. And of course, it's back to its own resistance, not support, resistance. That's an interesting thought. Here we are back to resistance, high volume, overbought, and over on equities, we had a shellacking for a week. Heavy volume pickup very quickly. Look how quickly we picked up on volume. And of course, we're back to oversold from the high levels of, potentially overbought. That's why we had these question marks in the last couple of videos. What's going to happen to the breakout? Is it going to do what it did in 82, which we have espoused a lot about, and that is go back and test its breakout area? You bet. It's pretty normal for that to happen. That should not cause anyone huge amounts of concern. But look, let's be honest here. We're managers of capital. We hate watching capital go down while we're trying to find opportunity. I don't think for a second I'm not there with you every second of the way, maybe more. feeling of regret watching red ink. I don't like it. I despise it, but I know it's part of the process. I know that red ink gets us closer to good deals for cash that's sitting around, and that proper planning allows us to know that, look, if you really needed the money today, it wouldn't be getting red ink because it wouldn't be in stocks and it wouldn't be exposed to those potential volatile risks. But in the grand scheme of things, in a 4, 5, 10, 15, 20-year plan, a week or 5 days of trading transactions does not a question mark make. So again, part of our process here is to hope to coach things along so that we begin to bend our mind a little bit around that emotional strike and that emotional spark that comes when you see these bad headlines and you see the sell-off and you go, oh my God, Mike, gee, it was up last year. Why is it already down this year? Oh, but doesn't that mean it's going to be down the whole year? And doesn't January effect mean if it was bad in the first week and it's bad for the first month, which by the way ends tomorrow, that you can just see that this weekend will be filled with headlines that say, oh, the January effect says this is going to be a down year. Well, boy, that can become self-fulfilling, just so you know, that in fact can be another step in a self-fulfilling prophecy if too many people believe that and too many people call their brokers or their advisors, they go to their E-Trade account and they sell their stuff because they buy into this January effect. Well, you could have another month that doesn't look too pretty. But somewhere in here, these volumes, these footsteps we see, high volume oversold or approaching oversold, high volume back to resistance, approaching overbought, into support, slowing down the pace of selling. Sure, it's volatile, but look at the difference between these 3 days and these 3 days. That's a bit of a difference. And in fact, the opening today, if we open right where we are right now, we're actually, let's just see, the close was 179.07. We'll open at 178.88. We're literally 20 cents away from that close. You get back above that and close, that's the first technical signs of a low. So, look, will it be followed by high volume? We can only watch. But again, these are the indications. These are the things you try to wrap your mind around. Now, hey, look, if the GDP had come in well below expectations and had done a 1.2 print instead of a 3.2 print, and if data shows, as you will see all sliced and diced by tomorrow morning, the data in GDP first run numbers show that government spending went way down, the public picked up, corporate spending picked up, revenues rose, cash flows rose, GDP rose. Think about it. Those are not bad pieces of news. And you would fully expect that if you hadn't lived through 08 and 09 and you watched a 3.2% GDP report, you would not expect the Federal Reserve to still be having a QE program. You just wouldn't. Now, one more thing about QE. I want you to understand a couple of things. Indeed, a month ago in December's Federal Reserve meeting, they began the process of tapering, the taper caper, the big feared thing. Tapering for this year is much like fiscal cliff was for the beginning of 13. We went into December 12 absolutely terrified of the fiscal cliff that was soon to be arriving on our doorstep. And of course, we replaced fiscal cliff with tapering. Tapering was the big thing as the year ended, and we feared how bad it would get. And of course, we're living a little bit of that self-fulfilling philosophy at this point in time. But let's go back to QE. Now, they've now made 2 official announcements about QE, and of course, QE is what affects both of these charts, or the perception of QE, the emotional charge that's attached to QE. But let's think about it sincerely for a moment. A month ago, the Federal Reserve decided they would buy $10 billion less in bonds each month. Now, only one of those months has gone by. which means that exactly $10 billion less of bond buying activity in the last 30 days has taken place. Now, I want you to understand that every day the bond market has over $1 trillion of valued bonds change hands. $10 billion is the equivalent of 330 odd million bucks a day out of $1 trillion. Now, that's a very, very, very small multiple mark decimal point. And it's only happened for a month. Now, yesterday they said for the next month they're going to taper another 10 billion. That means that 30 days from now, a grand total of $20 more billion will be tapered from the buying program. Now, if we add that 20 billion to the 10 billion that's already quote unquote disappeared, that will be a grand total of $30 billion in a 2-month time span that handles $1 trillion a day of activity. Do you logically think, just think about it, let it sink in, do you really think that is a gigantic shift that is going to change a $17 trillion plus economy, one that just got better, by the way, yet another quarter of positive growth that so many people don't believe? Let that sink in. Let that sink in. Let this picture sink in. Look at this activity that we're watching. There's a mirror to this. If you kind of look at these perspectives, you can see the mirror. Running to bonds because you're afraid of growth and leaving stocks because you're afraid of growth, that really is kind of backward. So think about it. And what we're going to do is continue to look for opportunity during this selling, because this still looks a lot like 1982 to us. Talk soon.